Hello, today we're going to talk about accounts receivable. So accounts receivable is a part of balance sheet. It comes usually right after cash, and it's one of your most liquidable assets after cash. So you want to turn your accounts receivable into cash as soon as possible and hopefully have good policies in place to collect the money. So we're going to talk about everything around accounts receivable today and things that can go right, things that can go wrong, and how we can account for them as we're doing this particular topic. So what do we describe accounts receivable as and how they occur and recorded? We have seen them before. So receivable is amount that is due from another party, hopefully for something already you have provided, right, the service. So company must also maintain separate account for each customer. So you would know sub account for each customer. So if you go to the bank, they know how much money you have in your account. So you are sub account for them. All right. So this graph shows recent dollar amount received per percentage of well-known companies. So like Pfizer, for example, 8 million versus Callaway Golf is 128 million. Depends what kind of company it is. Some companies that are like, let's say McDonald's, right? They probably don't sell too much stuff on the receivable unless if it's a branding of the name or franchise fees. They might not have as much receivables as other company like John Deere who makes tractors. All right. So one of the things we have not seen much, but we all know when we go buy something, there's going to be some sales tax and other things associated with that. There's a credit card calculations. So sales and credit, let's take a look how it looks and how it impacts us. So for example, on July 1st, tech company had a credit sale of $950,000 to CompStore and collected $720 from RDA Electronics. So in this case, and we kind of know how to deal with the journal entries, debits equal credits, debits on the left, credits on the right, right? So when the sale occurs, right, and we're not getting money right away, we're going to increase our assets, accounts receivable, CompStore, $950, and we're going to recognize the sales. We're going to credit sale $150. Now, when collection occur, you're really changing one asset, right, for another. So now you receive cash, so you debit cash for $720, and you credit accounts receivable for $720. All right. So what you'll see in a subsidiary ledger, right? In subsidiary ledger is information you keep separate for each customer, right? So RDA Electronics right now, you just credited their account. So if they call you, right? If they call you and say, hey, how much do I still owe you? You're gonna go and see, okay, you had a beginning balance of 1,000. Now you just credited 720, right? So their balance is only 280. So that information, right, gives you the letter you're going to send them, your outstanding bill, right? I'm sure we all got a bill maybe from medical office or cost from, I don't know, if you have kids in daycare, right? Your outstanding balance or gym, right? So they know how much it is. They're getting this from your accounts, in your case, for that accounts receivable ledger. All right, so each account, right? So this one is increased, right, by $950. Now we have a CompStore has $2,950. So each of those totals would equal the general ledger final total and accounts receivable. So we have a one account, main account, right? And then we have a detail available in subsidiary ledger, right? And then some of you homework problems going to ask you to create a schedule of accounts receivable. All it is a summary of each of your customers and the balance outstanding at any given day. And each time I do this, it goes back here. Okay. All right. So what happens if you sell on a store credit card? So we all been in a gas station, they want to sell us brand name credit card or this particular store, Macy's credit card, right? So they actually most likely have a third party managing it for them, but they're considered to be the one who is administering it. So we're going to see how it looks on your books if a sale occur on your credit card if you're the company who has one. So on November 1st, tech company recorded sales on their own credit card, an amount of $1,000. So on December 31st, TechCom recorded an adjustment entry for interest earned for 1.5%, because if it's yours, right, then it's going to be obviously any interest earned on a card would belong to you. So when you have a sale, right, it's not a credit card collectible because it's still accounts receivable. It's just how you're collecting. But the difference between just accounts receivable and a credit card, now you can collect interest, right, if the customer is not paying you. So you're going to debit accounts receivable, credit sales. But then when interest occur, right, you have accounts receivable. Again, it's going to go into their credit card bill, and then you have interest revenue. So you're separating between sales revenue and interest revenue. All right. What if it's a credit card that is a bank credit card? I think it's not a secret for anybody that credit card companies charge fees of the company who utilizes them. And this is why some places want to take cash versus credit card, because they don't want to pay fee. Or some places you walk in, they would not take credit card under $5 or under $10, because the company has to pay the fee. They exchange of it, they get cash right away, and burden of collecting is not on them. So different companies, I think Visa, MasterCard, anywhere from 3 to 4%. I think American Express and Discover a little bit higher for 5% a fee. So companies are willing to pay that fee to make the sale, right? And have cash available to them right away. So burden over credit as on a credit card. So let's see how it looks on our books. On July 15, tech company has $100 of credit card sales with a 4% fee, and a $96 is received immediately on deposit. So credit card company would automatically transfer money. Everything goes electronically. So what happens? We're going to debit cash for $96. We're going to pay credit card expense right away because it's a price of being in business. So paying the fee to credit card company is a price of being in business. And we're going to credit sales for $100. Okay. Now, what happens when we have sale and installment? Sale and installment, when you're going to sell things in increments, used to have a land contract when you could buy a house directly from the owner and you own part of it each time you paid off. So installment sales is amount owed to customer from credit sales for which payment is required in a periodic amount, so over an extended period of time, and customers usually charged interest. So you would recognize sales as you're receiving the money. More in intermediate accounting, you'll be doing those entries, but I just want you to know there is such a thing as installment sales out there. All right. We're going to get into direct write-off method and then get into non-direct write-off method, which is really meat and potatoes of this chapter. So being in business, it means maybe sometimes you would not collect on some of your debts. So let's see how it looks. So direct write-off method is some customers may not pay their accounts. It's just how it is. You do your best credit check. You have some policies in place, but you do want to be in business. You'll take some risks and somebody might default. So uncollectible amounts are referred to as a bad debt. Okay, so there's two methods of accounting for bad debt: direct write-off, which we're going to start out with, and then allowance method, which is gonna we'll be moving in next. So first, direct write-off. You will be using direct write-off when it happens once, literally in a blue moon, and you cannot really estimate when it's going to happen. So every 5 years, somebody doesn't pay you. So you'll use a direct write-off. Otherwise, it's considered to be GAAP, generally accepted accounting principles, to use allowance method for all others. So tech company determines on January 23rd that it cannot collect $520 owed to its customer, J. Ken. So when they find that out, they have to write it out. And when we say write it out, they have to remove accounts receivable from the books. Normal balance sitting there is a debit. So they're going to credit accounts receivable for the amount, and then they're going to debit bad debt expense. It's going to go to your income statement for that year because it became apparent you would not be collecting. I don't know, J. Ken might be dead. J. Ken might have a bankruptcy and you will not get anything from bankruptcy distribution. Whatever the reason for it, after a period of time, you have decided that J. Ken no longer can be pursued for collection. So you have to notice the specific customer is noted in transaction because you're going to be having sub accounts for each of them, right? Sub ledger. And so we can make a proper entry in customer accounts receivable subsidiary ledger as we have seen before. Well, guess what? Kent was not dead, and Kent really wants to use our product. So he comes back and says, please, 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 I'll be good. Can you sell me more stuff? I say, no, we're not selling you anything. You didn't pay us first time around. He goes like, no, I'll make a payment that I was past due right away. So we look at Kent and we say, okay, we're going to give you another chance. So for us to take his payment, if somebody offers you money in business, you take it. Okay, so, but we don't have a room for him to accept the money anymore, right? We already wrote off his account. So the first step you're going to do, you're going to reinstate the account by debiting accounts receivable and crediting bad debt expense. So we really never credit expense account, but in this case we do because we're literally reversing this entry. We're reversing it and reverse like it never happened before. So you're going to debit accounts receivable, credit bad debt expense, and then you're going to receive cash towards that amount. Another important thing I want to mention, okay, and you might see it in some of the homework problems. Let's say Kent is going to pay us only $300, not $520. You don't have to reinstate a full amount. You can reinstate just the amount he's going to pay us. So it's not all or nothing. So if he's going to pay only $300 and it's the only thing he's paying, you're going to reinstate just that amount because you already made that entry. So there's no point for you to reinstate full amount and start, worried about how you're going to write it off again in the future. Or maybe you did write off and then bankruptcy occurred and you still got some money, so you have to reverse it. Okay? So assessing direct write-off method, expense recognized principal require expense to be reported in the same accounting period the sale helped to produce. So this Kent situation could have happened last year, and now you're writing off this year, so you're not matching your revenue and expenses. Materiality constraint performed direct off method is result of similar allowance method. So if we do think direct write-off method and allowance method produce the same results, company sometimes decides to do direct write-off and they say it's a wash. Materiality, we say us keeping track of it would not materialize or defer changes in the income statement as much. So direct write-off method usually does best match sales and expenses. All right, let's do allowance method. So this is really the one, there's a lot of things going on. So I would definitely separate them, compartmentalize them, make sure you take good notes, stop the video, and maybe go back and make sure you got it before you move to the next one, right? I know this material. I know I don't want to make this video longer than it has to be because I know you have a pause button to stop and rewind, okay? All right. Allowance method. So at the end of each period, we estimate total bad debt expense expected to realize from a period sales. So the same thing like we did adjusting entries, right, before, earlier in our studies of financial accounting. In the end of a period, we say, hey, this year passed and some of those accounts will not be collected. What can we do to figure out approximately what it would be and set up allowance can account from them in a period that have occurred. There's two advantages to allowance method: to record estimated bad debt expense in a period when related sales are recorded, so it's in the same time frame, and it reports accounts receivable on the balance sheet at estimated amounts, so we see net sales exactly where they need to be. All right. Allowance method recording bad debt. So tech company had a credit sales of $300,000 during its first year of operation. So at the end of the first year, $20,000 of credit sales remaining uncollectible. So that's reasonable, right? Based on experience of similar business, tech estimates that $1,500 of its accounts receivable will be uncollectible. So they think $1,500 would be uncollectible. They're not sure which accounts they are. They don't have a name who is not going to pay yet. They just know and we're going to talk about different methods based on some kind of estimated method. It's about 1,500. So what we're going to do, we're going to recognize on December 31st bad debt expense, and we're going to create an account we have not seen before. It's called Allowance for Doubtful Accounts. It's a contra account to accounts receivable. So that's account that's going to reduce accounts receivable. So if I'm going to say, what is my net accounts receivable? You're going to take accounts receivable less allowance for doubtful accounts, and that's what your net accounts receivable is. So that's exactly what adjustment entry looks like, right? It's between income statement and balance sheet account. It doesn't include cash. So, and you're going to post them into UT accounts. So here it is. This is how it's going to look on my balance sheet, right? My net accounts receivable, it's 18,500. And it's part of my current assets. So this is two ways how you can present this on the balance sheet. Okay. Let's say next year, it's apparent J. Kent is definitely a troublemaker. And this is a wrong number. It should really be here. I'll change it right here. It's supposed to be 520 here. 520. Okay, we're back to presentation. So 20, determine the 520 account is uncollectible. So we're going to take allowance for doubtful accounts. Remember that account we created, contra account, and just write off can account. So what we did, we recognized expense in the year when it's occurred, but now able to use that reserve. It's like your savings account. It's like your, I don't know, pantry, right? You keep couple cans of beans in the pantry or whatever it is, right? So it's your reserve. You're going after your reserve. You don't run to a store each time. Well, maybe you do, but if you would keep extra, right, you could go to your pantry. So that allowance for doubtful accounts, that's your reserve. So you're going against the reserve. And obviously you're going to post it in accounts, but this does not touch income statement because you already accounted for it. So once we write out bad debt expense, what really happened, your realized value of accounts receivable did not change because it came from one account into another, okay? All right. Now, the same thing as we did with direct write-off. If Ken comes back and pays us money back, right, to restore credit standing, we're going to reverse the account we just did, right? So we're going to debit accounts receivable and credit allowance for doubtful accounts and accept the cash from Ken. So if Ken comes back and wants to pay us, we're going to take his money. Okay. All right. Let's use our method. So this is very important slide. Let's make sure you guys understand where everything is because we're going to have different methods. So it's a different calculation under different methods. It's one or another, but we're learning all of them. And this is where I think students sometimes like thinking like, oh, I just have to learn how to do this. You're going to learn how to do this under this condition. You're going to learn how to do this under this condition. How do you learn to do this under this condition? Okay. It's like almost we have to dress for 4 seasons. In Wisconsin, that's kind of the same thing. You don't wear the same thing. We have to assess based on each situation. So there's really 2 methods, but it's really 3 because this method has 2 of them. So first method is percentage of sales method. We also gonna call it income statement or income statement approach, right? And another method, it's called accounts receivable method. We call it balance sheet approach. The only reason is because accounts receivable is on balance sheet and sales are on income statement. All of them dealing with accounts receivable, but how you calculate it is your base is 1 percentage of sales and 1 is accounts receivable. Under accounts receivable method, we have 2 different methods. So it's really 3, 1, 2, 3. Percentage of accounts receivable and aging of accounts receivable, okay? So percentage of accounts receivable method and both aging of accounts receivable, this is very important. For accounts receivable method, AR, we do care about beginning balance and allowance for doubtful accounts. I didn't write it all out because I want to make sure you guys, we do care about beginning balance. I want you guys to remember this. I even made this thing jump. Here we go. It's going to jump. Okay. So important. We do care about beginning balance of allowance for doubtful accounts for this two methods under number 2. All right, let's get going. So when we do percentage of sales method, we're going to take current period times bad debt percentage, and we're going to have an estimate bad debt expense. So for example, we have Musicland has a credit for 100,000. We have 0.6% of credit sales. We think it's going to be uncollectible. So we're going to take 400,000 times 0.6% or 0.006 on your calculator. That would be 2,400. So we're going to debit bad debt expense for 2,400 and allowance for doubtful accounts for 2,400. So the entry is the same. How you estimate is different, right? Now, if we use that second, right, percentage of receivable method, this is when we do care about allowance for doubtful accounts balance. We have to compute estimate of allowance for doubtful accounts using year-end accounts receivable. So we start out this year-end accounts receivable times bad debt percentage. So we're going to have a bad debt expense is computed as following. Total estimated bad debt expense, so whatever we decided, minus previous balance of allowance for doubtful accounts. So that beginning balance we need to consider. So that's going to be our current bad debt expense. So let's take a look at example. Musicland has 50,000 of accounts receivable and $200 credit balance and allowance for doubtful accounts. 5% of receivable are uncollectible. So we're going to take 50,000 times 5. So we have 2,500 we think is uncollectible. So that's great, but we cannot just book 2,500 because we already have 200 sitting there. So we have to go in allowance for doubtful accounts. Normal balance, right, is 200. So we've been told it's 200 right now. They kind of don't start from the top here. Unadjusted balance, 200. So a normal balance 200, actually, this is very important. I just don't want to make this video extremely long. And some homework problems, it's going to be on the debit side. So if it is on the debit side, you have to make up the difference, right? Whatever the deficiency you have to just get to this balance. So their goal is to get to 2,500. We already have 200, so how much more do we need? 2,300, right? If we had just crossed this for a second, a balance of 200 debit, right? We would need 2,700, right, to get to 2,500. So make sure you understand which, if it's a debit or credit side. So we're going to book a bad debt expense and allowance for doubtful accounts for 2,300. Next thing, we're going to use aging for receivable method. We're going to classify each receivable, how long it's past due, and each group will be estimated based on a percentage. So we kind of say, okay, whatever is due past due longer period of time, most likely not going to be collected is things that are just recent. So this is different customers that I have. Total receivable is 50,000, but some things that are overdue $900 more than 90 days, I think 40% of them not going to be collected. So 900 times 40 is $360. Things that are due past due 61 to 90 days, I think probably not be collected. 25%. It's all scientifically, historically been calculated. So 475. So I'm breaking down based on past due. So not yet due, I think 37,000, only 2% would not be collected. So 37 times 2 is 740. So I do all the math, I add them all up. So I think my estimated uncollectible account is 2,270. For aging accounts receivable, I do care about my allowance for doubtful accounts as well. So you're going to look at your $200 again to get to 2,270, right? So you're going to book only 2,070. So first you determine current balance, 200. Determine what his account balance should be. We just calculated 2,270. Then you're going to make adjusting entry to get from here to here, and you need 2,070 to get there. Okay, so this is example when the balance is a debit. I was mentioning this before, but this is important. Just kind of slide 30, go back to it because it is in the homework and students freeze a little bit. So if you have a debit balance, for you to get to 2,270, 500, and if you put 500 here, invisible 500, that's going to get you to 0. And plus you need another 2,270. So remember, debits, credits, right? They offset each other. So to get to 2,270, you really need 2,270, you need 2,770. So do pay attention if it's a debit or credit is a beginning balance. So we do care about beginning balance for doubtful accounts. All right, this is a good summary method graph. It's also exhibit 910. So that's something, income statement approach, percentage of sale, and balance sheet approach. So we just covered percentage of receivable and aging of accounts receivable. Under all of those methods, right, we do care about beginning balance. All right, couple more things. Notes receivable, the same thing is a accounts receivable. It just has some kind of bearing interest in it. So it would have amount, how much is due, when it's due, to who, right? It would have some days due. I honestly, not my favorite part of a chapter, because I myself pull out calculators and say, well, I don't know how many days it is. Pull out your calculator to get the days, right? Or if some people do the knuckles, what months have how many days. So some homework questions do have days. So it's 90 days, but if you need to break it out and see where the day is, if homework would ask you on this day how much interest they earn, you literally have to look at a calendar how many days it is. How do we calculate interest? We've done this before. We take a principal amount times annual interest rate times expressed in fraction of a year. So in this case, we have a $1,000 note at 12%. That's an annual rate. All the financial data in this book over 360 days. So 90 over 360 days. Therefore, your interest is $30, right? So notes receivable usually recorded as single note receivable account to simplify record keeping. So on the day when you get your note, you're going to just say notes receivable, which is an asset, and credit sales. On the day when you're getting your interest, right, you would make a different entry. This is interesting. Okay, so the seller may accept note receivable and accounts receivable customer to allow extension to pay past due account. To illustrate, assume tech company agrees to accept $232 in cash along with $600. 600 says they will just fix things as we go along. They 15% note from Joe Cook to settle her $832 past due account. So what's happening, they're going to say, hey, let's come up with financial agreement that interest would be involved, right? This swapping accounts receivable with note receivable. So we're going to debit $232 cash. We're going to set up notes receivable and write off accounts receivable for Jay Cook, right? I'm going to new learning objective. So in the end of 60 days, they're going to pay $600 and 15% interest, right? All right. So principal and interest on a note are due at maturity days. So now Jay Cook has to pay the money. So principal times interest times 60 over 360 time. So when the note is paid, Jay Cook is going to pay $615, 600 of this note receivable. We're taking it off because note is gone. And then we have our interest revenue of $15. All right. And if we need to dishonor a note in case does not pay it, we're going to pay debit accounts receivable again and start pursuing, send the boys to collect the money, right? And because if time passed 60 days paying it, you cannot collect interest because you signed a legal document for 60 days only. So it becomes accounts receivable again. And now you have to collect it as accounts receivable. All right. If we have some number of days as of December 31st, right? Let's say 15 days only passed, right? So out of 60 days, we have 12%, 3,000 note, but only 15 days passed. This is going back to adjusting entries. We're going to debit interest receivable and credit interest revenue. This is adjusting entry between income statement and balance sheet account, no cash involved. So 60 days have not passed, but 15 days is in this year and 45 days is the next year. So next year, right, when you pay the note, you debit cash. And this is like pause the video, write it out, make sure you can back out of those numbers, right? So days in December was 15. This is when I was telling you guys you should get a calendar out. In January, we had 31 days plus 14. So we had 45 days. So we had 45 days. So you would either do full interest or 45 over 360. If you do full interest, you just know it's $60.15 you already accounted for, and you have to write off your notes receivable. So debit notes receivable plus interest, but you recognize revenue only from January 1st till for February 14 in this case. Quickly here, you can sell receivables. It's called factoring receivables. I'll let you guys read it in the book. I'm not dealing with that as much, but some companies do sell them with recourse, without recourse. It'll take a risk on the company of who's taking it, if it's going to be collectible or not. But companies do that to get cash available to them as soon as possible. And one of the last things in this chapter, we have accounts receivable turnover. We take our net sales divided by average accounts receivable net. So net accounts receivable, it's accounts receivable minus allowance for doubtful accounts. And this ratio provides useful information for evaluating how efficient management has been and grading credit to produce revenue. So this all I want to show you guys. I do hope you learned a lot. I hope my head was all the way in the video too, because I just saw half of it. But it doesn't matter as long as you get your information. That would be great. I'll see you next time.